Hi, everyone. Welcome to Fundamentals Unfiltered. I'm Matt with the Fundamental Investing Institute. We are recording this on Tuesday, October 28th, 2025. So, I got to start the way I've been starting the last few weeks, and that is talking about gold prices. I know that I'm beating a dead horse here, but something interesting happened last week because we always record this on Tuesday mornings, and I think the last two Tuesdays I've been talking about gold prices. 2 weeks ago, gold had hit $4,100 an ounce. Last week, it looked like it had closed on Monday, reaching $4,400 an ounce. And I was suggesting that, and this was based on a lot of market commentary that I was reading and just looking at the general price trends of gold, that it was increasingly looking like a momentum trade. And the way momentum trade works is that there are a lot of institutional and psychological factors that drive prices to the upside or to the downside. But the point is that price action is increasingly delinked from the underlying investment thesis. And in the case of gold, that investment thesis, or I guess just the general trading thesis, is gold as an inflation hedge and gold as a hedge against fiscal problems in various governments. And because gold is a world commodity, this is not exclusive to the United States. So it's really kind of a hedge against fiat currencies in the United States and elsewhere. But I'd say in the last 2 or 3 months, it was just gaining increasing levels of momentum that seemed to be delinked from that underlying thesis. But anyway, literally, as I was recording last week's episode, gold was in the middle of a huge sell-off. I think it was the biggest sell-off, one-day sell-off in over a decade, and that sell-off has more or less continued. I think gold. I think I looked at it this morning. Looked like gold futures were around 39.40 an ounce, so it actually broke 4,000 to the downside. I'm never going to claim to be able to time markets, so the timing of this was just completely random, completely coincidence. But it did highlight how momentum can reverse and it can go in a big way to the downside, and that's what happened. And because a lot of people are buying futures contracts, in futures contracts use a lot of leverage. I would venture to say that there were quite a few people who lost a lot of money last week. Now, a technical note on gold prices. When you look at gold prices, there are kind of three prices that you generally see quoted in the news. We have spot prices, and spot prices are prices for the underlying commodity for an immediate transaction. So the spot price of gold is what you would pay for gold for immediate delivery. And then you have futures contracts. Futures contracts are standardized contracts that trade on an exchange, and they are for future delivery of some underlying commodity, in this case gold. So you have some future settlement. Now, there are two futures prices that generally get quoted in the financial news. One is what's called a continuous contract, and what a continuous contract does is it takes all of these different futures contracts with future settlements, and it links these contracts together into a single price. So it creates a single price out of all of these different futures contracts that are trading at slightly different prices because they have different settlement dates, future settlement dates. And then you might see what's called the front month contract. And the front month contract is just the futures contract that is nearest settlement. So it has the most recent future settlement. So those are the two futures prices that you see. And then you may also see what are called ETF prices, exchange traded funds. These are pools of money that issue shares, and those shares trade on an exchange just like a stock. But what those ETFs do is they hold, in the case of gold ETFs, they hold the underlying commodity. They hold the gold, and then you own a piece. When you buy a share of an ETF, you hold a piece of that, of all of the gold that the ETF owns. So that's another thing, is you might see ETF share prices. But again, just a technical note, I wanted to mention that these are kind of the different prices that you may see. So if you're looking at gold prices, it kind of depends on what are you referring to, spot prices or futures prices, and if futures prices, which futures price are you referring to? So hopefully there's some clarification on that. Now I wanted to get into a couple of things that have happened in the last week. One is we had inflation numbers. Now the FOMC meets this week, and they're going to determine the federal funds rate, and the expectation is that they're going to move the federal funds rate down by 1/4%. So the federal funds target range right now is between 4 and 4.25%. If they go down 1/4%, it'll be 3.75 to 4%. The concern among a lot of people is that the most recent inflation data that came out, the Consumer Price Index, showed inflation, yearly inflation, so this is for the previous 12 months, yearly inflation as 3%. And this was slightly below what economists expected, and so policymakers were kind of talking that up as a victory, but 3% is still significantly higher than the Fed's target of 2%. So the Wall Street Journal has a great editorial about this. It's called "Getting Used to 3% Inflation," and it sort of highlights the complacency among policymakers in just accepting 3%. And we have to remember, this 3% is coming on the back of the very high single-digit inflation that we experienced 2 years ago. So you saw a huge decline in the purchasing power of people's income and the purchasing power of the dollar, and that's increasingly being the case. As the article points out, 3% inflation may not sound like a lot, but if you accrue that over 10 years, it's a loss in purchasing power on the dollar of over 26%. So it's a significant decline in the value of currency. I guess the real issue is if people start to expect that this is kind of the new norm. I mean, the Fed is cutting interest rates at a time when inflation is still above its target. If consumers start to expect that this is the new norm, their behavior is actually going to create inflation, because if you feel that prices are going up, you accelerate your purchases, and what we call the velocity of money, that is the churn of money in the economy, goes up, and the faster the velocity of money, the higher prices go. So if this shifts inflation expectations to the upside, that could be a big problem. One of the things that I read recently is that Duke University did a survey. It was jointly conducted with the Federal Reserve Banks of Atlanta and Richmond, where they do this survey with corporate CFOs, and it's a pretty significant number of corporate CFOs that are in this survey. Based on that survey, the corporate CFOs said that they're expecting to raise prices by an average of 4.3% next year. So a lot of the expected price increases are still in the pipeline, as it were, and that's another thing that could make things a little bit challenging for the Fed. I would also argue that there are people that are going to disagree with me. I've got friends in the housing sector. I've got friends in commercial real estate. They're certainly going to disagree with me on the state of credit conditions, but I would say overall, credit conditions are not overly tight. I mean, we have record high equity prices. We have risk premiums, which are essentially the rates on risky debt versus the rates on risk-free debt or treasuries. Those premiums are at historic lows. You have And then I would also go back to gold prices, which even with this recent sell-off, gold is still over 50%, is still appreciated over 50% on the year. So none of these are signs of tight credit conditions. Quite the contrary. So it just raises the question of, is the Fed willing to accept higher inflation? And I think another thing to point out is we want to look at what's going on in the job market. I mentioned this a few weeks ago, but if we try to use monetary policy or looser credit conditions to fix what are in fact structural problems in the labor market, it's going to be inflationary. And Amazon announced they have 30,000 planned layoffs. They've announced 14,000 of those 30,000 planned layoffs. Seemingly, there's a lot of factors going into the Amazon layoff question, but it's part of a trend among companies. They're planning growth and they're planning capital expenditures around AI. What they're not planning is hiring. In fact, a lot of companies are planning quite the opposite. They're planning big layoffs. So this is a structural problem in the job market where companies are just able to grow with less people. And it seems to probably hit administrative jobs the hardest, but I think it's going to hit other both white collar and blue collar jobs. So Amazon's announcement was one of the biggest ones, but that was by no means the only one. And there was an article in the journal called "More Big Companies Bet They Can Still Grow Without Hiring," and it's profiling this trend. Names a number of companies that are doing just that. They're expecting growth, but they're not planning on hiring. And this kind of stagnation in the job market is not something that can be fixed with monetary policy. So it just makes me a little nervous. I would definitely think about ways to. Hedge inflation at this point. I'm trying to do so in my own portfolio, but it's something that investors need to keep in mind. And this AI trend is probably going to continue. I'm not going to get into this much here, but something that I want to talk about probably in next week's video is this increasing interconnectedness. I talked about this a little bit last week, but there's a lot of commentary among investors and investment managers about how the whole AI issue is starting to look like the dot-com bubble of the late 90s. And there's a lot of there are a lot of parallels. There's certainly some differences, but one of the big issues is in the energy sector, and some of the valuations in AI-linked energy stocks are just really insane. 100 times forward earnings, things like that. So I'm going to talk about that probably more in next week's video. I wanted to mention a book that I read a number of years ago, and I continue to come back to. I wanted to mention this book in part because I'm in the middle of a huge reading project on the global economy, and I am not starting a lot of new books right now, but this is a book that I come back to all the time, and it comes back to a lot of the risk that I talk about on this in these videos, and I talk about on our blog and elsewhere. Whenever we think about the future, it's really best to think about the future as a disbursement or a range of outcomes rather than one specific outcome. And this book, Thinking in Bets, Making Smarter Decisions When You Don't Have All the Facts, it's written by Annie Duke. Annie Duke is a retired and very successful and famous poker player. She also has, I believe, a PhD in psychology from Columbia, and she's very much an academic, but she writes this book on ways to think about the future and ways to analyze our own decision making. So the two takeaways, I think, first is we need to think about the future as a range of outcomes, not as a specific projection, because we can't predict the future. So whether we're thinking about gold prices, whether we're thinking about reinvestment in our businesses, whether we're thinking about buying stocks and bonds, whatever, we have to think about the future as this range of possible outcomes with different probabilities to those outcomes. The second major takeaway that I have from this book, probably the biggest takeaway, is when we think about our own outcomes, what we have a tendency to do is to look at successful outcomes and just kind of assume that we followed a very good, rigid process, and we look at failed outcomes and kind of assume that the process was flawed. Regardless of the outcome, very often there's a random element. And what we have a tendency to do is when we have failed outcomes, and I certainly did this for a lot of years, when we have failed outcomes, we'll analyze our failures, but we never analyze our successes. We analyze our failures because we want to know what we did wrong. And when we have successful outcomes, a lot of times we assume that we did everything right, so that doesn't really warrant much thought. What this book really changed in my mind is how we have to analyze outcomes regardless, and we have to be honest about where we made good decisions, bad decisions, and where the outcome was just random. So she goes through some great examples, and a lot of this ties back to her poker days, but it's become a book that I think a lot of business people have followed, and rightfully so. One of the blurbs in the back is from Howard Marks. Howard Marks is a brilliant credit and very successful credit manager. He runs a mostly distressed debt company called Oak Tree Capital, and he's someone who thinks very seriously about risk. So frankly, anytime I see him endorsing a book, I jump on. But this is a book that's been very widely endorsed in the investment community for a number of years. I highly recommend it, and it's a book that I constantly go back to. So just in the interest of profiling some books that have influenced me and continue to do so, I want to do that on this show. With that, hope everyone has a great week. Best of luck in your investment endeavors, and as always, focus on the fundamentals.